Investing, investing, and investing. Well, investing was never an easy task. It's not only because of lack of patience, but it also requires you to actively pick the stocks. What active picking of stock means that you need to invest in those stocks that will continuously outperform the market in the longer run. And it's always a difficult task because you need to analyze a lot of stocks, you need to analyze a lot of sectors, the economic condition, and what not. And thus, the data suggests that very few active investors are able to consistently beat the benchmark over the longer run. But then the question arises, then what actually we need to do? Well, we came across a very interesting book named The Little Book That Beats the Market that was written by Mr. Joel Greenblatt. In this interesting book, Joel Greenblatt talks about a formula that combines Warren Buffett value investing with Benjamin Graham's deep value approach. And he calls this formula a magic formula. What's so magic in that? Because in his formula, just two factors. Yes, looking at just two factors, he was able to consistently outperform the US market for a longer period of time. Let's look at some data here. The average return of this formula was 24% against 9.6% for S&P 500 during the 21-year period. This chart clearly shows the massive outperformance of the formula that was achieved over a long period of time that was backtested in his book. So in this video, we'll talk about two such parameters that was used in the magic formula. And if this formula was so simple, then why aren't everyone out there simply following this formula to outperform the market? To find that out, watch the video till the end. So the first parameter that was discussed in the book is consistently find a good company. Now, what exactly is a good company? Well, in the book, it was referred to as the company that generates a higher return on the invested capital. Well, we'll understand this with an example. Now, Mr. A wants to start his own business. He has two options. One is opening a grocery store wherein he would require an investment of rupees 5 lakh. And according to a market survey, he found out that the stores of such sizes are able to generate a yearly profit of rupees 1 lakh. The other option available to him is that apart from opening a grocery store, he can open a shirt manufacturing business, which would require an initial investment of rupees 15 lakh. However, it would generate a profit of rupees 2 lakh. Now the question arises, which actually is a good business? Well, if you look at simply in the absolute terms, then business B generates a higher profit than business A. However, according to book, you need to look at the returns on the invested capital, which means that business A was able to generate a return of capital employed of 20% versus just 30% in case of B, and thus company A is a better buy over company B. And thus, one such factor is returns on capital employed. However, to analyze a good company, ROC is just one metric. There are various other metrics you need to look after to find a good company that will consistently beat the market over the longer term. In that case, you can check out learnup.com, where our great mentors ranging from Ramdev Agarwal, Mr. Atul Suri teaches how to consistently buy a good company. There is a designed framework which we can use and apply to pick the companies. So do check out learnup.com. Now the second parameter that was discussed in the book is the hunt for value. That is, you need to buy a company at a much bargain price. How exactly we need to do this? One such parameter that was discussed in the book is the earnings yield. Earnings yield is basically the EBIT divided by the market capitalization of the company. This is just one parameter that was discussed in the book. So just for example, if a company has an EBIT of rupees 100 and the market capitalization of the company is rupees 1000, then the earnings yield of the company is 10%. Thus, the two parameters that were discussed in the book were a good company and at a valuable pick, basically through a high ROCE and a high earnings yield. But what do you actually need to do when you get the ROC and the earnings yield? Well, according to book, you need to rank the companies on the basis of that. I will just give an example how to do that. So let's just understand this with an example. Let's suppose company A has an ROC rank of 3 out of all the companies and earnings yield rank of 4. Thus the total ranking of company A comes out to be 7. Let's talk about company B. Company B has an ROC rank of 5 while earnings yield rank of 1. Thus the total rank of the company is 6. Now according to this formula, company B is a more valuable pick than company A. And that's it. You just need these two factors, that is a good company and at a valuable price, and you will be able to choose your stock. However, in this book, Joel Greenblatt has talked about two such factors you need to avoid. So the number one factor that he discussed to avoid is that you are required to ignore the financial stocks. It is so because the efficiency of the financial stocks cannot be judged through a simple ROC metric because it's a leveraged business. Now the second factor that is mentioned in the book is you need to avoid illiquid stocks. So basically invest in stocks that are more liquid. However, the real question to address is, if this formula is so simple, why aren't everyone out there following this formula? I mean, they need to find a good company and they need to find a valuable pick. Hold on there is a catch. This is so because this formula requires you to follow it consistently over a longer period of time. And we know very few people out there have the patience to hold on to their investment for a long period of time, especially when it involves year and year of underperformance. Now, why I am telling you all this? Well, let's talk some data here. As I can see in this chart, we have backtested the data on the return of 30 companies chosen each year from the magic formula. We can notice that over the last 10 years, there has been practically made no sense in using the magic formula. The outperformance with respect to Sensex is almost negligible. However, as pointed out by Greenblatt, this formula will truly show its magic when it is consistently followed over a longer period of time with few years of underperformance. Now we'll analyze a very interesting data for the 10-year period, however this time data ending 2018. So as I can see here, the magic portfolio has given an annualized return of 14% versus 7.75% for Sensex over the 10-year period ending 2018. However, because of just 2 years of underperformance, that is 2019 and 2020, it looks like the magic formula is not worth it. However, consistency is the key. So we just talked about how magic formula works in the Indian market scenario. However, there is much more beyond than simply ROCE and earnings yield to find a good company and at a valuable pick. To get help on that, you can simply check out learnapp.com, where we have various courses on how to find a good company and how to do a valuable pick that will help you to actually implement this formula. For example, we have a course on value investing, which is taught by CIO of ICI Prudential Mutual Fund, Mr. Sankaran Narayan, who talks about value investing and how to pick a value stock from scratch. I would request you to check out learnapp.com. Link is in the description below. And guys, you know we are near our 100k mark and we want your help and support to achieve that milestone. So please like, share and subscribe this channel and do check out these two videos. Do continue with your support. See you in the next video.